years ago, I set out to answer this question by creating a video where I invested $100 into 5 different things. Today, I'm going to compare the results from those 5 investments that you can make from your laptop and try to finally answer the question once and for all. We're going to be using this grid to judge each one in these categories. First up, learning curve. This is how long it takes to learn the ins and outs of each method. Ideally, we want this to be as short as possible. Next is passive income potential, which is how much money an investment can earn for you passively while you still own it, without needing to sell it. Then there's tax efficiency, which refers to the specific tax advantages or benefits available for each type of investment that can help you pay less tax. After that, we have risk level, which is about how likely you are to lose money and how much the investment's value might go up or down. And finally, we're looking at the results. This is where I'll reveal my percentage return over the last 4 years and exactly how much my $100 investment is now worth. Before we jump in, please remember, I'm not a financial advisor. I'm just sharing my own results and strategies that have worked for me over the years. Please also do your own research. Okay, first up is individual stocks. Individual stocks give you the chance to own a piece of a company you believe in. This can be really exciting because you're directly investing in businesses that you think will grow or succeed. For learning curve, I'm going to say this is high. If you want to be successful picking individual stocks, then it's not just a guessing game. You'll need to dig into the nitty-gritty of a company's fundamentals. This includes looking into the financials, who's leading the company, and how well known the brand is. When I invest in individual stocks, I look through income statements, balance sheets, and cash flow statements. So when I invest in a stock, I'm in it for the long haul, which means at least 2 to 10 years. A great way to learn how to do this is by using an investing app with a demo account, which lets you play around with fake money until you're confident with your strategies. For passive income potential, I'm going to say this is good. You see, when you own a stock, there are 2 ways you can make money. Firstly, if the price of the stock goes up during the time you own it, you can sell it for more than you paid. Secondly, you can receive dividends. Dividends are regular payments to shareholders. Not all stocks pay dividends, but if they do, this means you can receive money without ever selling your stock. This is essentially passive income. Now, for tax efficiency, this is great. If you use the right accounts, then you can reduce your tax burden. In the UK, these are called stocks and shares ISAs. You can set one up on most investing apps and any profits you make are safe from taxes. In the USA, there's something similar called a Roth IRA. These accounts work like a shield, protecting your profits from the tax man. While there are different rules depending on where you live, the idea is the same. Please bear in mind that I'm not a tax advisor and you should do your own research as everyone's circumstances are different. So what's the risk? This is definitely high. Back in 1995, during the dot-com boom, I got lucky and picked a few great stocks. I sold them at the right time and made a lot of money in a short period. But when the bubble burst, some of the other companies I'd invested in, ones that cost me very little, went out of business completely, even though I ended up making money overall. It just shows how risky investing in individual stocks can be, especially if you put all your money into just a few companies. If they fail, you could lose everything. So let's look at how much my $100 investment is now worth. Let me refresh your memory. Here's what I invested in. So I'm going to throw a dart at the board, and as you can see, I randomly selected 20 different stocks, and wherever the dart lands, that's what I'm going to invest in. Now I've just got to put on a blindfold. Okay, here we go. Oh, you hit it. Right, let's see what we got. And we've gone into Samsung. That investment is now worth $67.66. But don't forget my dividends. Over the 4 years, I made 10 cents. So that leaves me with a total of $67.76. That's a negative 32.34% return. This example perfectly shows how hit or miss individual stock investing really is. That dart could have just as easily landed on Apple, Microsoft or Nvidia. So let's have a look at how much I would have made if that dart had landed a bit differently. A $100 investment in Apple 4 years ago would now be worth $170. The same investment in Microsoft would be $188. and, drum roll please, Nvidia would be worth $908. Those stocks have boomed in recent years, and luckily I have some of those in my personal portfolio. But this just goes to show you can't just leave individual stock investing down to luck. You have to be strategic with your stock picks, and even then the market is unpredictable. If you want to try this out, just download Trading 212. It's a great app for beginner investors because it lets you use a demo account to practice trading with fake money. This way you can learn how it all works without risking any real cash, just like I mentioned earlier. It also lets you set up a stocks and shares ISA if you're in the UK, which protects your investment returns from taxes. But again, I'm not a tax advisor, so please do your own research as everyone's situation is unique. Trading 212 also lets you buy fractional shares, which means you don't have to buy a whole stock. That's how I was able to own just 0.07 of a Samsung stock instead of having to buy an entire share. As I was going to mention Trading 212 anyway, I reached out to see if they'd be interested in sponsoring this portion of the video. They agreed and are offering a free fractional share worth up to £100 to anyone that uses the code Tilbury when they create an account. Plus you can get more free shares by inviting your friends. Both of you will get a free share as long as they fund their account. I'll leave the link in the description if you're interested. Second is a real estate investment trust, otherwise known as a REIT. I know this one sounds pretty complicated, but it's actually quite cool. Imagine your friend collects $100 from 3,000 people, giving him $300,000. He then uses that money to buy a property, rents it out, and shares the rental income with all 3,000 people who helped him buy it. That's a simple way to explain a REIT. It allows anyone to invest in properties without needing to buy one themselves. Think of it like you own the front door, someone else owns a window, and a few others own the bricks, which means together everyone owns the entire property and shares in the profits. For learning curve, I'm going to say it's moderate. And that's because getting started with REITs is much easier than buying physical property. It's not like you need a huge down payment or a mortgage, and there's no need to deal with agents or solicitors. However, you do need to understand how REITs work. They own things like offices, shopping centres, apartments, hotels, and much more, and they get their income through rent. For passive income potential, I'm going to say this is great. REITs are well known for paying high dividends. This is because the law says they have to pass on at least 90% of all their profits to investors. So as long as the REIT is doing well and its properties are rented out, you can earn a steady stream of passive income. Most businesses sign long-term leases on their commercial properties. Therefore, most of the time, income is pretty stable and reliable. But of course, just keep in mind that your earnings depend on the REIT you pick and the types of properties it owns. For tax efficiency, I'm going to put this down as great. This is because in many countries, REITs offer great tax benefits. For example, in the UK, you can hold REITs in a stocks and shares ISA, which means you don't have to pay taxes on your profits or dividends. In terms of risk, I'd have to say this is medium. REITs are generally less risky than buying a single property because they invest in multiple properties, spreading out the risk. However, they're not risk-free. If the real estate market takes a downturn, or if the REIT struggles to keep its properties rented, you might see both a drop in dividends and the value of the investment. So what's my investment worth now? Let's flash back to me making the investment 4 years ago. As I'm in the UK, I'm going to use the Trading 212 website to put $100 into a similar REIT. Ready for the moment of truth? Looking at my investment now, I can see it's worth $98.59. So that's a small loss of 1.41%. This shows that even though REITs are normally more stable than individual stocks, they're not guaranteed to perform well. My REIT likely underperformed because it invested in commercial real estate, which struggled during the pandemic. But that's not the end of the world, as I made $11.93 back in dividends, meaning I'm actually $10.52 up. So that's 10.52% up. Third is cryptocurrency. Imagine a form of digital money that isn't controlled by any government or bank. That's what cryptocurrencies like Bitcoin and Ethereum are. These currencies run on the blockchain technology, which makes them secure, transparent, and almost impossible to counterfeit. Cryptocurrencies have created massive wealth for some people, with Bitcoin being the best performing asset of the last decade. But on the flip side, it's highly volatile and people have also lost fortunes. That's why I describe crypto as part investment and part speculation, and not for the faint-hearted. For learning curve, I'm going to say it's moderate. Crypto might sound complicated, but I'll break it down for you. First, you'll need a wallet. This is where you store your crypto. Think of it like a digital piggy bank, and there are different types. First are online wallets. These are easy to use, but you'll need to protect them with very strong passwords. Second are offline wallets, like hardware wallets. These are the safest because they're not connected to the internet. Next, you'll need to pick an exchange to buy and sell your crypto. Some popular ones are Coinbase and Binance. These platforms make it simple to trade, but make sure to choose a trustworthy exchange to avoid any issues. Then there's tokenomics. This just means understanding how the supply and demand of a coin works. For example, Bitcoin has a limited supply, which is why it's often called digital gold. For passive income potential, I'm going to also say this is moderate. Unlike stocks or REITs, crypto doesn't pay dividends, but there are ways to earn passive income. The first is called staking. This is when you lock up your crypto like Ethereum to help the system work and process transactions. In return, you get paid rewards, kind of like earning points for helping out. The second is yield farming. This is when you lend your crypto out to others and earn interest on it, similar to how a bank pays you interest when you save money with them. These methods can generate decent returns, but they do come with higher risks. If the coin's value drops or the platform you're using gets hacked, your income could disappear along with your crypto. That's why I personally don't mess with any of this and just hold mine on a ledger wallet. For tax efficiency, I'm going to have to say this one is poor. Taxes are a tricky part of crypto investing. In many countries, even swapping one cryptocurrency for another counts as a taxable event. And if you earn staking rewards, those are also taxed as income. You also can't hold crypto in tax-advantaged accounts like ISAs or Roth IRAs, which makes it less tax efficient than stocks or REITs. In terms of risk, I'd have to say it's very high. Crypto is one of the most volatile investments out there. Prices can soar 1,000% in a year, but they can also crash just as fast. Personally, I just invest in Bitcoin and Ethereum as they're more established and often referred to as blue chip cryptocurrencies. Smaller altcoins can be far more risky. You've also got to be cautious of scams. Since crypto isn't regulated, if someone hacks your wallet or tricks you into sending your coins, there's no way to get them back. So keeping your crypto safe is just as important as learning how to invest in it. So what's my investment worth now? Let's rewind to when I made this investment 4 years ago. So I'm going to jump onto the most popular Bitcoin app, which is called Coinbase, and invest my $100 in Bitcoin and forget about it. Ready for the reveal? The $100 I invested in Bitcoin is now worth $652.24. That's a return of 552.24%. Now, I know what you're thinking. That's insane, and it is. But I have to stress that this kind of growth is not typical. Bitcoin has been the best performing asset of the last decade, but most cryptocurrencies don't see these kinds of returns. Many lose their value entirely. In my opinion, crypto is exciting, and the technology behind it has the potential to transform industries. However, it's not for everyone. It's highly volatile, speculative, and requires a strong stomach to handle the wild price swings. Just remember, crypto is all about high risk and high reward. So if you're going to dive in, make sure you're doing your research and investing wisely. Fourth is gold. This is one of the oldest and most trusted ways to store and protect wealth. Gold is often called a safe haven because it's a great way to protect your wealth during uncertain times, like when inflation is rising or the economy is struggling. For learning curve, I'm going to have to say it's low. Learning how to invest in gold is pretty simple. You have two main options. First, physical gold. This includes gold bars and coins. Many people also think you can buy gold jewelry as investments, but you'll often pay more than the gold is actually worth because sellers add a markup for their craftsmanship. For this reason, I personally stick to gold coins. Just bear in mind, if you pick this option, then you'll have to store it somewhere safe. Second is gold ETFs. These are funds that let you invest in gold without physically owning it. For example, in the UK, you can use Trading 212 to buy shares in something like the iShares Physical Gold ETF. It's quick, easy, and you can buy or sell it with just a few clicks. Passive income potential is absolutely zero. Unlike stocks, REITs, or crypto, gold doesn't pay any passive income. It's not an income generating asset. It's purely a store of value. For tax efficiency, I'm going to put this as good. If you buy physical gold like gold coins or bars, the tax rules can be a little tricky. For example, in some countries, certain gold coins like the UK's Gold Britannias are considered legal tender, which means you don't pay capital gains tax when you sell them. However, this doesn't apply to all gold coins or bars, so you'll need to check the specific rules in your country. For gold ETFs, they're generally more straightforward. In countries like the UK, you can hold them in a stocks and shares ISA, which makes any profits completely tax-free. Interestingly, physical gold has another unique advantage. It can be used to transport wealth across borders discreetly. That said, this approach comes with risk, such as theft or legal restrictions on transporting large amounts of gold across borders. While it's not something I'd necessarily recommend, it's worth mentioning as a unique aspect of owning physical gold. In terms of risk, for today, I'm setting myself a challenge to prove this can be done. I've hand selected 5 different investments. These include index funds, business, art, individual stocks and cryptocurrency. The data suggests these are good investments during a recession. Therefore, after looking at each in detail, I'm prepared to put $1,000 of my own money into every asset so we can see the results together. However, this might not go quite to plan. I never thought I'd spend $1,000 on this. No, get out of it. Look at that! If you gave me $5 every day and I gave you $50 back, would you be happy with that deal? Of course you would. So why aren't you taking it? Let me explain. This leads me into investment 1, index funds. I'm giving this a 3 out of 10 on the risk scale as it's been delivering solid returns for decades. The figures don't lie. If you invest $5 every day, let's call that $150 per month into the S&P 500 at an average return of 8% for 45 years, then you would have $791,000. Now, according to Google, there are 16,436 days in 45 years. So now if we divide $791,361 by 16,436 days, we can see that every $5 you put in has turned into $48. That's pretty close to $50. Now I bet that's got you thinking about your $5 Starbucks frappe a bit more carefully. Index funds are seen as one of the safest investments over the long term. However, during a recession, they become even more appealing. This is because instead of betting on individual companies to pull through the tough times, you're purely investing in a long-term success of the whole market. Think of it like going to a horse race, and instead of putting all your money on one prize stallion, you decide to spread it across all the top performers. So now if one or a few of them lose, it should be okay because you will benefit from the others winning. This is a proven winning strategy. Over a 15-year period, 92% of the top hedge funds are trailing the S&P 500 index. I mean, these guys are meant to be the experts, but they are getting destroyed by a very hands-off investment which is so easy to manage. You may think the S&P 500 isn't very well spread as it's only made up of the top 500 American companies. However, as of 2017, only 70.9% of the companies that make up the S&P 500's revenue were from the US, so it's a lot more global than you might first think. But if you want to spread your money further, then there are lots of different funds that cover different countries and companies. I have some of my money in emerging markets index funds, as I believe we're going to see a big shift in global powers over the next 5 to 10 years. Even though I also invest elsewhere for bigger returns, I always gradually buy index funds what whatever the market's doing, be that trending up or down. There's multiple brokers you can use. If you're in the US, you can use public.com. I'm going to use my UK Vanguard account. Let's put $750 into the S&P 500 and $250 into a global index. There we go. All done. 88% of millionaires are self-made entrepreneurs according to Fidelity Investments research. So that brings us on to investment number 2. Business. I'm giving this a 3.5 on the risk scale, as unlike index funds, you could lose all your money in a bad business move. However, the power is in your hands, not someone else's. If you haven't started a business, then now could be the perfect time as we head into a recession. There's a good chance you'll be starting from your home and have minimal employees and very little overhead to maintain at this point. That combination puts you in a great position to provide an inexpensive solution and win over customers. In an economic downturn, businesses and consumers alike are looking to cut costs, which may allow you to break into the market. But your window of opportunity could close soon, as recessions are typically short-lived and followed by long periods of growth and prosperity. The period after World War II, for example, is considered the greatest expansionary phase in modern times. Similar points can be made for the years after the energy crisis recession, the Gulf War recession, the dot-com bust, and the Great Recession. Each recession was followed by a longer period of growth than the period of recession. The biggest mistake I see people making on a daily basis is putting all their money into assets they don't have direct control over. As you know, I'm not against the stock market. However, I don't think enough people value their skill sets. I was on a call the other day with someone in my free Discord, and he asked me an interesting question. He was making around $400 per month selling PDFs that help people in his country pass a state exam. He was wondering how he should invest that money to make more. Later on in the call, I discovered that he was currently only selling these templates with organic marketing, which proves there is a real demand for his product. If he just invested $200 per month back into paid advertising within his business, he could see an immediate return greater than any stock market investment. I think of it like starving a plant of water. You can't ever flourish in a drought. So if you've been overlooking business, then I implore you to dream big and prepare for the next expansionary phase. At the moment, I'm focused on growing my podcast, Strike It Big. We really need a way for episodes to be edited as we film them. That's why I'm going to invest this $1,000 into some new technology, which should save me time and help us post weekly episodes. Question: what do Picasso and Banksy have in common, apart from being era-defining artists? The answer is, you can invest in their work for a fraction of the asking price. That brings us on to investment 3, fine art. I'm giving this a 5 out of 10 on the risk scale. You might not have considered fine art as a potential investment. To be honest, neither had I, until I looked into the shocking stats. You know the S&P 500, that investment many millionaires don't stop banging on about.
S&P 500 index fund.
The S&P 500.
The S&P 500.
The S&P 500.
Well, contemporary art investments have actually done better than the beloved S&P 500 over the last 25 years. To be exact, the S&P 500 had a 9.5% average annual return, whereas contemporary art averaged 14% price appreciation. But surely, if we're facing a recession, the demand for these expensive paintings will drop, and then the value of our investment will plummet, right? Well, actually, the global demand held up pretty well during the last Great Recession. In 2007, global public auction sales topped $32.9 billion, while in 2008, the figures hit $28 billion. This only shows a slight dip in demand, and it was still higher than 2005 when auction sales were only $17.2 billion. Maybe more importantly, during 2009, Yves Saint Laurent's art collection set a new record for a single owner collection, totaling $483.8 million. To put this into perspective, this happened just 5 months after the complete collapse of Lehman Brothers and the markets. Again, if we look at our old friend the S&P 500, this didn't recover to pre-recession levels until 2013, 2 years later than the art market. Due to the eye-watering prices these paintings command, unfortunately this asset class has only been accessible to the already rich and powerful. There is also a degree of skill involved with picking the right pieces that the average investor just wouldn't understand. So, How are we going to invest this $1,000 in art? Well, I've been doing some research, and companies like Masterworks really stand out as they use data that isn't available to the average investor, and a top research team in order to determine which high-end artist markets have the most momentum. They're even asked by worldwide groups like Citi to collaborate on reports about the art market. This just shows how much comprehensive data they have. They help people get fractional pieces of art rather than the whole thing. This isn't NFTs, this is breaking a painting into shares so people can add a piece of it to their portfolio. Their incentives are also aligned with the investors, as Masterworks only make money when they sell a painting for a profit. With this said, I still think investing in art is for the long term, and that's why this platform doesn't actually accept investors that are older than 70. Oh damn it, looks like I can't invest this $1,000 after all. Only kidding, I've still got plenty of years left in me, you cheeky buggers. Masterworks aims to hold its art pieces for 3 to 10 years, at which point it then sells the painting and distributes the proceeds amongst investors based on their number of shares. But so far the paintings they have sold ahead of schedule have delivered 25% net returns for the last 4 years in a row through COVID, a bear market, and rampant inflation. Past performance is no guarantee of future results, but that's pretty incredible. So with that said, let's invest $1,000. I really like Mark Bradford's Promised Land. It even shows a progress bar that lets us know how much of the asset has already been bought. The paintings are valued every quarter, so I'll be keeping an eye on this closely. If you also want to get involved, then I'll leave an exclusive invite link in the description below. Imagine you invested $1,000 and woke up in the morning with $10,000. This is what most people dream of, and it's happened time and time again with investment for individual stocks. However, I'm going to give this a 7 out of 10 on the risk scale, as finding the best stocks to invest in isn't an easy task. Investing in individual stocks gives you complete control over how your money is allocated. When you invest in index funds, you can't pick and choose the individual companies. Instead, you're stuck with whatever the fund decides to do. So stock picking gives you the ability to beat the market, but bear in mind that 90% of people lose money, hence the high risk scale rating. If you're interested in giving this a shot, then now could be a very good opportunity, as the market has fallen from the highs of the pandemic and there are lots of deals available if you can find them. During a recession, it's more important than ever to invest in well-managed companies that have low debt, good cash flow and strong balance sheets. Your idea is in a frenzy and everyone is asking the same question. Should I sell now before it gets worse? But there's more to this than meets the eye. If you followed me for a while, you know I'm a serious investor who's obsessed with the stock market. And since so many of you have started investing because of my videos, I feel a responsibility to give you my honest take on the situation. So before you panic, let's take a step back and look at the bigger picture together. Every market crash has a cause, and this one isn't random. There are 3 main triggers behind it, and all of them tie back to one man, Donald Trump. Now, before anyone jumps to conclusions, this isn't about politics. I'm not here to take sides, and as a British investor looking in, my only concern is how this impacts investors like you and me. So let's break down the 3 biggest triggers behind this crash, why they matter, and what you can do to benefit from all this mayhem. Trigger 1 is Trump's trade war. Trump has always pitched himself as the ultimate deal maker. He's the guy who fights for American jobs and plays hardball with other countries. But the trade wars he's fighting could increase your weekly shopping bill and cause a recession. The last time the US tried this, it helped trigger the Great Depression, wiping out jobs and wrecking the economy. Now, history might be repeating itself. Stocks are already crashing, prices are rising, and if this spirals, it won't just hurt Wall Street, it'll hit you where it matters most, your bank account. Let me take you back to 1930, when I was just a boy. The US government decided to slap massive taxes called tariffs on imported goods to protect American businesses from foreign competition. It was called the Smoot-Hawley Tariff Act, and it turned out to be one of the worst economic mistakes in history. At first, it seemed like it would help. American companies wouldn't have to compete with cheap imports and more products would be made in the USA. But there was a big problem. Other countries fought back. Nations that used to trade with the US started raising their own tariffs, making it harder for American businesses to sell products overseas. Trade slowed to an absolute crawl. Businesses collapsed and millions lost their jobs. Instead of fixing the economy, it helped turn a regular recession into the Great Depression, one of the worst financial crises ever. Fast forward nearly a century, and Trump has brought back tariffs in a big way. In February 2025, Trump announced a 10% tariff on Canadian energy imports and a 25% tariff on other Canadian goods. In retaliation, Canada imposed a 25% tariff on American imports. Then in March, Ontario implemented a 25% surcharge on electricity exports to the US, affecting states like New York, Michigan and Minnesota. However, in my opinion, this was more of a symbolic move that wouldn't have seriously damaged the US economy. However, Trump didn't hold back, and instead of just brushing it off, he fired back by increasing tariffs on Canadian steel and aluminium to 50%. Unlike Canada's move, this wasn't just for show. It hit Canada's manufacturing industry hard while also driving up steel prices for American businesses that rely on imports. But why am I telling you all this? Well, this is where the real problem starts. Tariffs sound good on paper, as they're meant to punish foreign businesses while encouraging more stuff to be made in America. But in reality, they end up hurting regular people more than anyone else. As a business owner who manufactures products and imports from China myself, I know that when businesses are forced to pay more for materials, they don't just absorb the cost, they pass it on to their customers. That means higher prices on cars, appliances and electronics. In addition to this, food becomes more expensive because supply chains get disrupted, meaning that everyday essentials cost more, stretching household budgets even further. On top of that, other countries aren't just sitting around while Trump raises tariffs, they're forming new alliances to trade without the US. China is leading the charge with the BRICS alliance, partnering with Brazil, Russia, India and South Africa to reduce dependence on American trade. So the more the US isolates itself, the more other countries look elsewhere for business. So what's my opinion on all of this as an experienced investor? Well, if Trump goes all in on this trade war, history suggests it'll do more harm than good. While some industries might get a short-term boost, the long-term damage, such as higher prices, weaker global ties, and a slowing US economy, could far outweigh any benefits. But if I'm being completely honest, I don't think Trump actually wants high tariffs. I know that sounds crazy, but hear me out. Trump is, at his core, a businessman and a deal maker, just like me. That's why I believe he's using tariffs as a negotiation tactic, not as an end goal. So if that's true, what does he actually want? Well, I think he's after free global trade, but on terms that favour the US. And if he pulls that off, it could pay off big time. However, the problem is his approach is creating massive uncertainty. The constant backtracking, new tariffs and mixed signals are spooking the stock market because investors hate unpredictability. If this drags on too long, it could shake confidence so much that it pushes the economy towards recession, something even Trump's own administration has admitted they're willing to risk. Right now, the market isn't just reacting to tariffs. It's reacting to uncertainty about what comes next. And in investing, uncertainty is one of the biggest killers of confidence. Trigger 2 is Trump's stance on NATO. Trump has openly questioned the role of NATO, the military alliance that protects Western countries. He suggested that the US shouldn't keep defending allies unless they start paying more for their own protection. While that might sound like a fair demand, if the US steps back from its NATO commitments, it could create a power vacuum that countries like Russia and China might exploit. Markets hate uncertainty. The second investors sense that world stability is at risk, they panic. If NATO weakens, it could encourage Russia to push further into Europe, or even lead to new conflicts as countries try to adjust to a world without the USA acting as the global police force. More conflicts mean higher military spending, unpredictable trade relationships, and spikes in energy prices, all of which can rattle the stock market. Trigger 3 is Trump's secret plan. There's been a theory circulating that Trump may be crashing the stock market on purpose. I know that sounds crazy, but there is some evidence for it. Trump has never been a fan of high interest rates. In fact, he's called them ridiculous and has openly attacked the Federal Reserve for keeping them high. Now, here's where it gets interesting. The Fed is technically independent, meaning Trump can't just tell them to cut interest rates, but their decisions are based on economic conditions. If the stock market crashes and a recession seems inevitable, the Fed has no choice but to step in and slash interest rates to prevent a total meltdown. But why does Trump want lower rates? Well, because high interest rates slow down the economy. Businesses borrow less, stocks struggle, people stop spending as much, and for Trump, who loves growth and hates anything that makes America look weak, they're a problem. It's not just about making the stock market go up, it's way bigger than that. The US government is drowning in $36.5 trillion of debt, and when interest rates are high, the cost of that debt goes through the roof. Think of it like a massive credit card bill. Imagine you owe $36,500 and your credit card company charges 10% interest per year. That means before you even start paying down the actual debt, you're being charged $3,650 every single year just in interest. Now imagine the credit card company suddenly slashes the interest rate to 3%. Instead of paying $3,650 per year, your interest drops to just $1,095 annually. That's a saving of $2,555 every single year. Now you can put this money towards actually paying off your debt instead of just keeping up with your interest payments. Well, that's exactly what Trump might be doing, but on a $36.5 trillion scale. If the Fed lowers interest rates... Now I know I'm a bit of a boomer, but sometimes that can be a good thing. I've been around for a while and I've learned an awful lot along the way. Now your 20s are a fun part of your life, but they're extremely important at the same time. So here are 7 money-making habits I wish I'd known sooner, because if I did, I'd have made my first million a lot quicker, that's for sure. By watching this video all the way until the end, you'll be able to learn from my mistakes and hopefully do even better. Also, the last habit's a little bit controversial, so it might be worth sticking around for. Habit number 1 is embracing debt. I know this might sound confusing at first, as lots of people think that debt is bad, and you should avoid it like those online courses that cost $997. No, but seriously, it's one of the main reasons I was able to build my wealth from absolutely nothing to multi-millionaire. In my early 20s, I was building my businesses from the ground up, and I didn't have a lot of cash available to me, so I had to get very creative with my finances. I knew that if I wanted to grow my wealth, then I needed to control more assets. And the only way to do that was to use the power of other people's money. Now notice how I said I wanted more assets, and that's a very important point. Lots of people do the opposite and get into debt buying liabilities. Sadly, they're just digging themselves into a hole that they'll find it really hard to escape from. An easy way to find out if something is an asset or a liability is to figure out if the purchase is putting money into your pocket each month or instead just draining your wallet. My favourite thing about borrowing money is that I can buy other companies in cash, therefore getting a better price. I actually still do this today, as borrowing money is currently very cheap. How can borrowing money be cheap? This guy's a lunatic. Well, just think, if I can borrow cash at a 2% interest rate and put my money to work at an 8 to 10% return, then I'm ahead 6 to 8%. I just always make sure to run the numbers on my decisions and not leave myself too exposed to debt, so that if something went wrong, then I would be able to handle the repercussions. It's definitely true that you should be cautious of debt, but never fear using it to your advantage. If you're enjoying this video so far, make sure to smash that like button for the LTube algorithm, as it helps push this video out to a lot more people, and it's really appreciated. Habit number 2, being obsessed with success. I believe to become a millionaire, you must have laser focus, much like an Olympic athlete. I couldn't agree more with the quote, when you want to succeed as bad as you want to breathe, then you're going to be successful. Many of you aren't probably aware of this, but before I was known as a businessman, I was famous for flying radio control helicopters, and I competed to a very high standard all over the world. At one point, I won bronze medal at a world championships held in Indiana, USA. I would be obsessed with every little detail of my model. I did everything I could to win. I was absolutely relentless. To get to the top of anything, you need to put in the extra bit of work and then a little bit more. When I started my first business, I applied the same obsession. I set myself both short and long-term goals to keep focused at all times. Having a laser-like determination to succeed is key for your growth, and I was absolutely obsessed with hitting my sales targets. First, it was just to complete a year of business. Then it was to do last year's turnover in just 1 month. Then in just 1 week. But I always had the ultimate goal of becoming financially free. Even Elon Musk claims he regularly works 80 to 100 hours a week, and this is fueled by his obsession to hit his targets and meet his goals. How else will Tesla smash earnings reports and SpaceX land humans on Mars? The sad news is 60% of businesses fail within the first 3 years, and that's why focus obsession is so important. So stay focused and keep grinding. Amazon wasn't the biggest retailer overnight, and Kevin O'Leary said he would have laughed Elon Musk out of the building if he'd appeared on Shark Tank with a Tesla pitch. Habit number 3 is building income streams. As I've grown older, I must say my passive income streams have become very useful. I no longer have the energy of a 20-year-old. However, I don't have to, as I put in the work when I was younger, and now I can reap the benefits.
And you can make me do all the work as well.
Well, someone's got to. I created my first passive income stream accidentally when I refused to sell my apartment in my 20s. The apartment would have sold for around 40% less than I'd paid, and I wasn't interested in taking a hit like that, so I rented it out. This ended up being a great decision, as this paid the mortgage, and after 4 years the apartment sold for 60% more than I'd originally paid. So not only did I receive rent every single month totaling more than the mortgage payment, I then sold the property for a huge profit and put that money to work in the stock market. This really showed me the power of passive income, and I was hooked. Now, I admit the term passive income has become a bit of a buzzword online, and the truth is no income is truly passive, as there is always something that has to be done. However, some income sources are certainly more passive than others. The idea is to create something once and have it pay you as much as possible with minimal effort. Passive income is very addictive, especially when you wake up and you realise you just got paid for sleeping. A good way to start is to grab your free stock from the public app, worth all the way up to $1,000 if you're in the USA. And if you want to grab $10 worth of free Bitcoin from Coinbase, then that's open to everyone. So I'll leave those links in the doobly-doo below. Habit 4. Knowing when to quit. Now, I know this one might sound a bit strange. Quitting is usually seen as a bad thing, but in my experience it helped me go from a carpenter's apprentice earning less than $2 per hour to a millionaire by my late 20s. When I was working that minimum wage job and I first had an issue with my manager bullying me, I could have kept going and worked my way up the company gradually, but I decided to quit. That led me to starting my own business, and within a few months I was drowning in all the paperwork, so I decided to quit that job and I hired someone to help. And before I knew it, I'd replaced all the jobs I could with other people. This allowed me to focus on being the captain and steering the business in the right direction. The big lesson here is not to be too proud to quit when you don't like something, or you feel the effort is not worth the reward. I see so many people struggling at university and working long days and nights for a degree they don't actually want. They have just been pushed down that path by teachers and parents. Of course, this isn't everyone, but in my opinion, quitting has its time and place, and there is no shame in admitting something isn't for you. This isn't to say that you should quit just because something's hard, but there has to be a reason to put in all the hard work. Don't let others shame you if you make the hard decision to move on to bigger and better things. After all, the opportunity costs of staying where you are could be much greater than you realise. Just imagine if I'd stayed working as a carpenter making wooden trash cans all my life. Nah, that'd never have happened. Habit number 5 is treating your body like a sports car. Brum brum. I know I might be sounding a bit like a fitness guru, but as cheesy as it is, without good health, you won't be able to unlock your full earning potential. I had to relearn this lesson recently when the pandemic hit. Lots of my staff were in lockdown, which meant I decided to work 3 months flat out. I was even in the warehouse packing and shipping orders with minimal staff, as I didn't want to let my customers down. I actually worked 15 hours a day, 7 days a week for 3 months straight. I got multiple shops and warehouses. Then Almost overnight, the internet made it irrelevant. I had two choices: give up or adapt. You know me, I wasn't about to quit. So I threw myself into learning everything about making money online. And like most people today, I fell for the hype. I tried every method out there. And guess what? None of them were as easy as people said. But through trial and error, I cracked the code and rebuilt my businesses. But this time with the internet at the core of my strategy. Fast forward to today, and making money online isn't just important, it's an essential thing everyone should be doing. That's exactly why I'm making this video. I spent years testing, failing and refining, losing millions, making millions, and learning what actually works. Now with this knowledge, I can help you avoid all the mistakes and fast track your success. So if you're tired of false promises and ready to commit for the next 6 to 12 months and build something real, this is for you. No gimmicks, no BS, just the process that actually works. All right, so this is the online wealth wheel. And whether you realize it or not, you're already on it. There are three main stages that define where people are in their journey to making money online, plus a secret fourth stage that only a few ever reach. We'll discuss that one at the end. Let's kick things off with stage one. This is where everyone starts with no side hustle. And sadly, 55% of people never start at all. Inflation is making everything more expensive. And let's be real, relying on a single paycheck is more dangerous than ever. So if having a side hustle is essential, why do 55% of people still avoid it? Because the online space is a jungle. It's full of ads pushing proven methods that confuse more people than they actually help. The key to starting the right way is picking a method that suits your skills, budget and lifestyle. If you already have a skill like video editing, graphic design, coding, or even setting up Discord servers, people pay great money for these services and there's no shortage of demand. But what if you don't have a skill to sell, or quite simply don't want to deal with clients? That's where product-based businesses come in. One of the best options is selling products online without ever holding inventory yourself. But I'll get into this in more detail later on. That brings me on to running a failing side hustle. I'm classing a failing side hustle as earning less than $50 per month online. Sadly, 28% of people are trapped here. A lot of people aren't going to like me saying this, but it has to be said. It's almost never your side hustle that's flawed or doesn't work. You're most likely just not putting enough time and effort in. I know that can be hard to hear, but this isn't really your fault. It's down to something called shiny object syndrome. This is when you constantly jump from one trendy online money-making method to another without committing and putting your absolute all into any of them. One week it's drop shipping, then print on demand, then selling books on Amazon KDP, then trading stocks, and then starting a social media agency. The truth is, all the online money-making methods I just mentioned work, but each requires a different level of time commitment, and you'll never get anywhere by jumping from one to the other. It's like that classic diagram of miners tirelessly digging for gold, only to give up just before striking it rich. Instead of pushing through, they abandon their progress, start fresh somewhere else, and waste all that initial effort repeating the cycle over and over again. If you get stuck in this dangerous pattern like the 28% of other people, then you need to recognize it and simply pick a method and stick to it. Forget the idea of a perfect side hustle. Just pick one that's easy to start and has the potential to scale. If you don't have a high income skill to sell, then I'm going to make this super simple for you. In all my years of experience, the thing that has made me the most amount of money online is e-commerce. So I recommend you focus on that, but not in the way most people do. A lot of beginners assume starting an online store means dealing with inventory, suppliers, or complex setups, but that's not the case anymore. That's because you can now utilize AI-built Shopify stores. Instead of spending weeks setting everything up like I had to back in the day, you can now use a free tool called buildyourstore.ai to launch a fully automated store that would normally cost $200 to $300 to set up. But this does it for free in a matter of minutes. You just just enter your name and email, pick a niche like fashion, tech or pets, and the AI chooses winning products, designs your store, and makes it look professional from day one. If you want to go through this process completely for free, then just click the link in the description and it'll walk you through everything. From there, it syncs directly with Shopify, giving you exclusive access to a 3-month Shopify trial for only $1 per month. But what about making sales? Well, the biggest mistake people make with e-commerce is giving up too soon. Surprise, surprise. This is probably because they don't want to deal with inventory or fulfillment. That's why the free AI store builder also walks you through how to integrate a tool called AutoDS, which is kind of like the autopilot system on a plane. It imports trending products, updates pricing and images, and even ships orders directly to your customers. This means you don't have to touch inventory, package anything, or deal with supplier negotiations. You focus on driving traffic and making sales while the system handles the rest. Full disclosure, AutoDS are long-term supporters of this channel, but even if they weren't sponsoring this portion of the video, I'd still recommend them. You can easily create a buzz around your products by creating videos about them on TikTok for free. If you get 100k views and just 1% of the people go and buy your product for $10, then that's $10,000 in revenue. So if you're serious about breaking out of the failing side hustle trap, then choosing a simple automated model like this gives you the best chance at success. No more bouncing between business ideas, just commit, launch, and put in the work to scale it up. Stage 3 is running a successful side hustle. Believe it or not, only 16% of people who start making money online ever make more than $50 per month. The people in this percentile make anywhere from $51 on the low end all the way up to $10,000 a month. Of course, the higher end is what I'd consider actually successful. So what are these 16% of people doing differently, and how can you start applying it to yourself? Well, there's some clear things that I've noticed that separate the people who struggle from those who actually make money online. And to help you get there, I'm going to break them down into 4 key steps that you can follow. Step 1 is to stop trying to appeal to everyone. You might think casting a wide net will get you more sales, but in reality, it does the opposite. If you try to appeal to everyone, you'll appeal to no one. So before you even start promoting your store, grab a notepad or open your notes app and describe.
There'll be too much competition in the online space.
Well, teenagers have an advantage as they understand the online world better than anyone else. It's just second nature.
But Mark, I don't know what to do.
Well, that's why I'm going to be revealing the 7.5 best paid online jobs for teenagers. And this isn't any old list. For each one, I'm going to provide a real life example of a teenager currently killing it in that job. Job 1 is an advertising deal broker. Teenagers doing this job earn as much as $100,000 to $120,000 per year. In 2021, I bought a Tesla Model 3 and I set myself a bit of a challenge. I wanted to see if it was possible to use lots of different side hustles to earn back the price of the car. One of the ideas my son and I came up with was to get it wrapped like a race car, which would involve securing paid advertisements. At this point, we received a cold email from a teenager called Christian, completely out of the blue, who said that he was able to secure the sponsorship we required for a 30% commission. Christian managed to get an offer of $30,000 on the table. Had we accepted this deal, he would have made a sweet $9,000 for essentially matching us with the brand and acting as the middleman. In the end, Curtis managed to secure a different deal with public.com, so we went with them. However, Christian has managed to secure many of these deals in the past. That's why we can still offer you a free stock worth all the way up to $1,000 from Public with the link in the description. Christian told me that the best way to be successful with this job is to make friends in the right places. He described it a lot like a jungle, where one branch would lead to the next one and so on. Once you start working with one big company, it becomes a lot easier as you can reference them as a past client and therefore demonstrate that you have experience in the areas that they require. So how does he do it? He uses different software to get the email addresses of influencers and just fires off messages until he gets a bite. Then he evaluates the needs of the clients that contact him back and runs a similar campaign focused on reaching out to brands on the influencer's behalf. It kind of reminds me of the book How to Win Friends and Influence People, where Dale Carnegie Carnegie talks about sending mail to powerful people and getting replies, only the modern day version. If we learn anything from Christian, it's the power of a good reference and relationships. Always do your best work because you never know where something might lead in the future. Job 2 is a Discord community manager for Web3. These teens make more than $70,000 a year, depending on their multitasking ability. When it comes to marketing for Gen Z, community is everything. Every brand under the sun is trying to build a community around their product. This is actually the main reason why Gymshark have set up their first store in London.
The real purpose of this store needs to be to really cultivate the Gymshark community and connect with people.
Now, if you've ever used Discord, then you've probably met a community manager. They're like the glue that holds everything together. I know a guy called Harry who hires community managers. He said that he wouldn't bat an eyelid at paying more than $2,000 per week if they were good at the job and represented the brand in a positive light. Additionally, if you're good at multitasking, there's nothing stopping you from being a community manager for 3 or 4 projects at the same time, which means big money. The job of the community manager is to be on the front line. You have to tell the story of the brand, be customer service and support, as well as supporting people when they're down and paying attention to global events. You need to be able to pause your schedule, be active when people are looking for you, and listen when people need your attention. Above all, you have to be the voice of the CEO, but not always speak on behalf of the company. Job 3 is writing scripts for content creators. These teens can earn upwards of $100,000, but can go a lot higher depending on the type of content and your experience. Words can make you sound smart, or they can do the opposite, depending on how they're deployed. That's why businesses hire copywriters, basically salesmen in print. Copywriters can make insane amounts of money. I'm talking over $500 an hour in many cases. It all depends on how good you are at making connections, your skill with words, and how fast you can write. Some charge as much as $50,000 for just one web page. You may be thinking, why so much? Well, it's all about value. If you charge $50,000 for a web page and it results in a business monthly profit going from $200,000 to $400,000, wouldn't you say it's worth it? It's all about leverage, making rich clients even richer, then asking for your slice of the pie. And it's not just websites either. People need quality writers for all sorts of things. Everything from TikTok scripts to threads on Twitter. Content is king, and the magician behind all of this is often the writer. I know a guy named Adam. He started off writing blog posts about his travels to earn passive income and live anywhere in the world. This later led him to working as a copywriter for large influencers. He followed the same strategy as Christian, got one client, which led to another, and so on. He told me when he offers a service, he always tries to be exclusive and do it in a way that no one else could. There's always going to be someone cheaper than you, but not always someone more expensive. Find the client who can afford to pay the premium, then learn to offer a world-class service. Job 4 is a SaaS software coder. These teens can earn between $60,000 and $80,000 a year. A guy called Sam King came on my podcast, Strike It Big, and explained how he built a multi-million-dollar business without ever having a normal job. Instead of building a traditional business, he decided to build a SaaS company. This stands for Software as a Service. Just think of how many online tools you use on a daily basis. I know I love Notion, MailChimp, Photoshop, and many $1,000 cash in my bank account, and I had a net worth probably 3 times that. But it wasn't always this way. A little over 3 years before this, I was buried in what felt like crippling debt. Now I really understand if you're starting from zero or even in debt like I was, it can feel impossible to move forward. And I'm not here to tell you this is going to be easy, but with the money saving tips and strategies I'm going to be sharing with you today, it's certainly possible to get some money saved up. The only reason I can remember the exact amount was because at 22, I spent $100,000. Hold on with that, I'll tell you how I spent my 100K later in the video. Let's first talk about how I got into debt and how you can avoid making the same mistakes. I remember when I just turned 18, a friend of a friend agreed to sell me his car. I didn't have the money at the time, but he convinced me it was a good idea to take out a credit card and completely max it out. I didn't really understand how credit cards work because they never really covered that in school.
but he told me if I fixed up the car a little bit, I'd be able to sell it for a profit and pay off the credit card within a month, and then I wouldn't be paying any interest. Now, being young and a little bit silly, it seemed like a no-brainer to me. A few days after buying the car, you guessed it, the engine blew up. I had been sold a faulty car and I was left with a large credit card bill that I had no way of paying back. Over time, this credit card bill started growing until I felt it absolutely crippled me. In that moment, I made a promise to myself that if something sounded too good to be true, then it probably was. I remember sitting back on this big old brown couch and wishing it would just swallow me up. My credit score was terrible, my future didn't look great, but I decided I wasn't going to let my life be ruled by one mistake. I wanted to pay off my debts and save lots of money, and you can unlock exactly how I did it just by clicking that thumbs up button. So first I started tracking all of my money. Every penny that went in and out of my bank account I tracked. I thought of my bank account a bit like a ship with a hole in it, and it was slowly dragging me down. I needed to find the holes so that I could fix them and get my life back on track. Nowadays it's even easier to do this, as you can download a budget management app like Yolt or Mint. I'll leave some links in the description below. Trust me, if you take the time to do this, you will be amazed how much money you're losing from little expenses you don't really need. One that's a huge problem now is all the subscription services, like your cell phone, Netflix, and even those mystery boxes we all sign up for. Now, we sign up for these things and then we never cancel them, and every month they leech off our bank accounts even if we don't use them. By tracking everything, it gives you a much better idea of your financial situation. Once you understand where your money's going, it's actually much easier to take control of it. With this information, I was able to take the next step and set some targets. Without a target, it's very, very hard to save any money, because as soon as something shiny and new comes along, you end up blowing all your money and having to restart from zero. A target gives you a direction and helps you to resist all those personalized ads on social media that are trying to separate you from your hard-earned cash. I first had a year-long vision, which was to be entirely debt-free by the end of the year. But I knew if I was going to achieve that, I needed to break it down into manageable steps. When I started working backwards from my vision and thinking how much I needed to save every month, every week, or even every day, everything seemed much more achievable. I knew that if I hit my savings targets every week, then I would achieve my vision. These are called process targets, and they're great as they allow you to take small steps towards a big vision. The only thing that could stop me now was myself. So I needed to set some rules. I fully committed to these rules, and I printed them out and I stuck them on my bathroom mirror. Every day I would read them so that I would stay on track. It made it a lot easier for me to make the right choices when I was tempted to give up. Rule number one was save first and live on what was left over. By making my targets more important than my lifestyle, it meant I never had that much money to waste, so I made the most of every penny. Rule number two was wait 24 hours before buying anything. Have you ever really got excited about buying something and then a few days later that feeling just fades away and you start to regret what you've bought? By waiting 24 hours to buy something, you're able to think about it with a much clearer mind. Just doing this has saved me so much money, especially when I nearly bought a jet ski. My friend had just bought one of these and was going out every weekend and having a great time. He gave me a go, and as you can imagine, I absolutely loved it, so I decided I'd buy one. However, I waited 24 hours and decided to just go out on my friends for the next 4 weekends. I had a great time, but then he decided to sell it. He said he was bored of it, and he would, to be honest, I'd enjoyed riding it, but I felt the same. So by waiting that 24 hours, it saved me a big impulse purchase I would have regretted. Rule number three was not to fall victim to peer pressure and lifestyle inflation. It's so easy to increase your spending when you start earning a little bit more money because you want to impress your friends and your family. But if you can resist this, you'll be able to save a lot more. I actually still shop at the cheapest grocery stores because I know it's all the same stuff, just better value. The next step was to start paying off all my high interest debts. I had lots of different debts, some from friends and families and others from credit cards. And as bad as it may sound, I needed to prioritise the highest interest debt first, which was the credit cards, as they were actually costing me more money and also destroying my credit score. There was really no point having money in a savings account paying 1 to 2% interest if I was still paying down a loan that was charging me 20+%. By paying that off, that was like getting a 20% return on the stock market, which is pretty spectacular. So if you have debts and money in savings, then pay them down. That's what I would do. It's the best guarantee return you're ever likely to get. So I stopped using my credit cards and I set up automatic payments so that I wouldn't be late paying back any of my bills. The faster I could pay these debts off, the better, and then I could be using my credit cards responsibly to build my credit score. In order to do this, I had to master the next
To start investing all over again, I'll do things a little bit differently. So if you can follow all 5 of these steps, then you'll be well ahead of me when you get to my age. Step 1. Adjust your risk tolerance. In hindsight, I realised that I may not have taken as many risks as I could have during my younger years. The reality is that in your 20s, you typically have more time than money. This means that any risks you take have minimal downsides compared to those that have families and a mortgage. This is the time to build your empire, so being scared of taking risks is actually the most dangerous thing of all, as it means you'll fall short of your full potential. Of course, you should do everything in your power to swing the odds in your favour. However, you won't be able to eliminate risk entirely if you want to become wealthy. There is still going to be some risk in every opportunity, as nothing good ever comes easy. When times are hard, people are much more likely to let that little bit of doubt get inside their head and talk them out of whatever they want to do. I've seen countless friends say they're going to quit their job to start a business, but they never make that leap because they don't want to risk their comfortable income. When I'm judging whether or not to make an investment, I compare the potential risk with the opportunity cost of not taking that risk. Opportunity cost is what you give up when you choose one option over another. Thinking about this helps you make better decisions about how you use your resources. I'm not saying I always make the right decisions, but on average, I've come out profitable when I've used this tactic, and I also never want the thought of what could have been eating away at me. So the best way for you to grow your wealth is to take calculated risk with your money and use that time to grow your wealth faster than everyone else. Step 2, set it and forget it. I definitely should have automated my investments a lot sooner, as it forces you to prioritize your investments as the money is taken before you can spend it. This is when you arrange to have a fixed amount of money taken out of your paycheck or bank account every month and put into a predetermined investment. Investing $100 in an S&P 500 index fund is a good example of this. This will allow your wealth to compound over the years without you ever having to really think about it. This is a very straightforward process. First, determine how much money you want to save and from which account. Then go to an investment app and look for an automatic investment option and choose how you want to invest. They'll do all the paperwork. Once you sign off on the bottom line, the automated magic begins. In my experience, the majority of people that lose money when investing waste their time trying to pick the right stock at the right time. And if you've been watching my channel long enough, you'll already know that it's not easy to time the market. For me, investing is all about growing your money over the long term. ETFs allow you to invest in an entire market quickly and in a single transaction by tracking the performance of an index. You can choose to invest in specific regions like the top 500 companies in America with the S&P 500, the entire stock market, or even specific sectors like tech. InvestEngine is a Which recommended provider and is a platform that really resonates with me, as their entire focus is on long-term ETF investing. They offer ISAs, which are essentially fortified investing accounts protecting you from taxes. Because no one likes the tax man. With ISA accounts, you can only invest £20,000 per year, but any profits you make can be withdrawn completely tax-free. So I definitely recommend creating an ISA account with them and protecting your returns. If you sign up to InvestEngine today using my link, you'll receive a £25 welcome bonus when you invest your first £100. So you can get a 25% return on your money from the start. They even have an auto invest feature, which invests any cash that hits your portfolio straight into the ETFs you pick, so you really can set it and forget it. Thanks InvestEngine for sponsoring this portion of the video. Step 3, avoid temptation. I understand why people were drawn into the crazy crypto investments a couple of years ago, as this was similar to penny stocks back in my day. When there's a craze like this happening, lots of people feel like if they don't invest, they'll lose out on an amazing opportunity. So they start investing in things without fully understanding them. This has to be one of the most risky things that you could ever do, and it's probably the biggest investing mistake I see people making. I speak from experience. I made a few lucky investments in penny stocks when I was younger, and had I continued on that path, I would have lost everything. To be more exact, I had the opportunity to invest in a big group with a couple of billionaire friends. Everything they touched seemed to turn to gold. I can't reveal